If you observe carefully what's happening with retirement accounts right now, you'll notice something extraordinary. Over the past 18 months, the largest pension funds in America have quietly reduced their stock allocations by an average of 12%. This isn't speculation, this is documented fact. These are the same institutions managing trillions of dollars for millions of retirees, and they're making moves that most individual investors haven't even noticed yet. Your 401k represents decades of disciplined saving. Every paycheck you've set aside a portion for your future. But what if the very structure designed to protect your retirement is exposing you to risks that weren't present when you started contributing? The changes happening right now in markets, in policy, and in the economic system itself demand your attention. This isn't about fear. It's about understanding what's actually occurring so you can make informed decisions about money you've spent your entire working life accumulating. This isn't a prediction. It's a logical consequence of observable forces that have been building for years. I've spent over 40 years studying economic cycles, managing one of the world's largest hedge funds, and analyzing how governments and central banks respond to crisis. What I'm sharing with you today comes from pattern recognition, not guesswork. When you understand incentives, you understand behavior. And right now, the incentives facing policymakers, central banks, and corporate executives are creating conditions that traditional 401k investors need to comprehend. Consider three specific data points. First, the U.S. national debt now exceeds $38 trillion, representing 124% of GDP. Second, over 70% of 401k assets are concentrated in just two asset classes, domestic stocks and bonds. Third, the average American age 60 has approximately $400,000 in retirement savings, with 85% of it sitting in tax-deferred accounts structured exactly like yours. These aren't random statistics. They're the foundation for understanding what happens next. To grasp what's happening with 401ks, you need to understand the mechanism itself. Your 401k is essentially a promise. The government promised to defer taxes on your contributions, and in exchange, you promise to pay those taxes later when you withdraw. But here's what most people miss. This structure creates a massive future tax liability that the government is counting on. Think of it like a restaurant meal. You've been eating for 40 years and the bill hasn't come yet. The government knows exactly how much is owed. They know when it's due, and they control the tax rates when you finally pay. Right now, there are approximately $7 trillion in 401k accounts across America. When baby boomers withdraw, those withdrawals become taxable income at ordinary rates, potentially as high as 37% federally, plus state taxes. This creates enormous future revenue for a government carrying record debt. But there's another pressure building. Stock valuations today, measured by the Shiller P/E ratio, are at 33 times earnings, a level only exceeded twice in history, before the 1929 crash and before the 2000 dot-com collapse. Meanwhile, bond yields, after the fastest rate hiking cycle in 40 years, have created the worst bond losses since the 1970s. Your 401k, statistically speaking, is overwhelmingly invested in these two asset classes at precisely the moment both face significant headwinds. History is an excellent teacher when it comes to retirement accounts and government promises. Let me give you 5 critical examples. In 1974, Congress created the Employee Retirement Income Security Act, establishing the modern pension system. The promise was security and tax advantages. But by 2008, those same pensions lost an average of 28% in a single year, and many never recovered before their owners needed the money. The people who were 65 in 2008 didn't have time to wait for recovery. Second, in 1971, President Nixon closed the gold window, ending dollar convertibility to gold. This started the era of pure fiat currency. In the following decade, anyone holding bonds or cash suffered devastating purchasing power losses. Stocks barely kept pace with inflation. Third, the 1987 stock market crash. 401ks had only existed for 6 years, and many participants watched 22% vanish in a single day. Those close to retirement had no time to recover. Fourth, the 2000 dot-com crash wiped out 50% of stock values over 2 years. The average 401k lost approximately 40% of its value. And fifth, 2008 financial crisis. The S&P 500 dropped 57% from peak to trough. The average retirement account lost 31%. What's the pattern? When you're relying exclusively on market-based retirement accounts concentrated in stocks and bonds, you're completely exposed to market cycles. And those cycles are as predictable as seasons, even if the timing isn't. To understand what's happening now, you need to understand three fundamental principles. The first principle is the debt spiral. When government debt exceeds 100% of GDP, there are only three possible outcomes: inflate the debt away, default on obligations, or implement severe austerity. Politically, austerity is nearly impossible in a democracy. Default is catastrophic. That leaves inflation. Think of it like a bathtub. You have a tub overflowing with debt. You can bail it out bucket by bucket, which is painful austerity. You can drill a hole and let it all drain out, which is default. Or you can add hot water until the cold water doesn't seem like so much anymore. That's inflation. Right now, with $38 trillion in federal debt and unfunded liabilities exceeding $200 trillion, the bathtub is overflowing. The Federal Reserve, regardless of what they say publicly, faces immense pressure to keep interest rates from rising too high for too long. Higher rates make that debt more expensive to service. This year alone, interest payments on federal debt will exceed $1 trillion, more than the defense budget. This creates a fundamental conflict. Savers want higher interest rates, but the government's survival depends on lower rates. Your 401k bonds are caught in this conflict. The second principle is concentration risk. The average 401k has limited options, typically 15 to 25 mutual funds, almost all of them stocks or bonds. This isn't diversification. It's concentration disguised as diversification. True diversification means holding assets that move independently of each other. When stocks crash, what happens to your bond fund? In 2022, we learned they fall together. Stocks dropped 18%, bonds dropped 13%. This hadn't happened in 40 years. Why? Because bonds and stocks are both paper assets valued in the same currency, subject to the same interest rate environment, and impacted by the same inflation dynamics. It's like having multiple boats in the same harbor. You think you're diversified because you have 5 boats instead of 1, but when the hurricane comes, all 5 boats sink together. Real diversification means some boats are in different harbors entirely. The third principle is the tax trap. Your 401k is pre-tax money. You got a deduction when you contributed, but you'll pay ordinary income tax when you withdraw. Here's the trap. You have no control over future tax rates. If you contributed when your tax bracket was 22%, but tax rates rise to 35% when you retire, you've actually locked in a worse outcome than if you'd paid taxes up front. With $38 trillion in federal debt and massive unfunded obligations for Social Security and Medicare, what direction do you think tax rates are heading over the next 20 years? Congress has already proposed wealth taxes, unrealized capital gains taxes, and higher income tax brackets. Your 401k is a sitting target for revenue-desperate legislators because it's a known quantity sitting in tax-deferred accounts that must eventually be withdrawn. It's the low-hanging fruit of tax policy. Let me tell you a story about 2 couples, both age 55 in 2007, both with $500,000 saved for retirement. The first couple, I'll call them the Johnsons, had everything in a traditional 401k: 60% stocks, 30% bonds, 10% cash equivalents. They followed conventional advice. They rebalanced annually. They stayed the course. The second couple, the Rodriguezes, had a different approach. They kept 40% in their 401k for the employer match, but they also diversified outside the 401k. They held 20% in inflation-protected assets, 15% in commodities, 15% in international developed markets, and 10% in alternative investments with low correlation to stocks. Then 2008 happened. The Johnsons watched their $500,000 drop to $340,000 by March 2009, a 32% loss. At age 57, they panicked and sold, locking in losses. They needed that money in 8 years. They couldn't stomach more volatility. By the time they retired at 65 in 2015, they had recovered to $420,000. They lost $80,000 of value at the exact moment when compound interest matters most. The Rodriguezes saw losses too, but their diversified portfolio dropped only 19% because their inflation-protected assets and commodities actually gained value during the crisis. More importantly, they had the psychological resilience to hold through the volatility. By 2015, their portfolio had grown to $730,000. Same starting point, same time period. $310,000 difference. This isn't made up. It's the typical pattern when you compare concentrated 401k exposure against genuinely diversified retirement planning. Now let's translate this to what really matters, how this affects you personally. If you're 50 years old today with $500,000 in your 401k, and 80% of it is in stock index funds and bond funds, you need to run through a realistic scenario. Over the next 18 months, let's assume stocks correct by 25% from current valuation levels. This isn't catastrophic. It's just a normal bear market, smaller than 2008. Your 400,000 in stocks drops to 300,000. Your 100,000 in bonds, if interest rates rise another 1%, drops to 91,000. Your total portfolio, 391,000. You've lost $109,000 or 22% of your wealth. But you're 50. You have 15 years until full retirement age. You have time to recover, right? Here's the problem. Every dollar you lose at 50 costs you more than a dollar you lose at 30 because of compound interest. That 109,000, if it had stayed invested growing at 7% annually, would have been worth 300,000 by age 65. You didn't just lose 109,000. You lost the future growth of that 109,000. More importantly, the psychological impact matters. When you're 50 and you watch 22% vanish, you start making emotional decisions. You reduce your stock allocation. You go conservative at exactly the wrong time. You lock in losses. This is what happened to millions of Americans in 2008, and it's the hidden danger of concentrated 401k exposure at the wrong point in the cycle. Based on these principles, here are practical guidelines that apply regardless of your specific age or account size. First, understand your actual allocation. Most people think they're diversified because they own 5 different mutual funds. Log into your 401k and look at the underlying holdings. If you own a large cap growth fund, a large cap value fund, and an S&P 500 index fund, you're not diversified. You own the same 50 companies in slightly different proportions. Real diversification means exposure to assets that behave differently. Second, consider the following strategic allocation for someone in their 40s through 60s with a 401k. Maintain 40% in your 401k to capture any employer match, but diversify the remaining 60% outside of traditional tax-deferred accounts. Within that outside allocation, consider 25% in inflation-protected assets, such as Treasury inflation-protected securities, or I-bonds, 15% in commodities, or commodity-related investments, 10% in international developed market equities, and 10% in alternative strategies with low correlation to traditional stocks and bonds. This isn't about abandoning your 401k. It's about reducing your concentration risk. Third, implement changes gradually over 6 to 12 months. Don't sell everything tomorrow. Market timing is nearly impossible. Instead, as new money comes in from paychecks, direct it according to your new allocation. As you rebalance quarterly, slowly shift toward your target weights. Fourth, prepare yourself psychologically for volatility. If you diversify beyond stocks and bonds, some of your holdings will look stupid in certain years. When stocks are soaring, your commodities will lag. When inflation is low, your inflation-protected bonds will underperform. This is the point. You want assets that don't move together. Fifth, avoid common pitfalls. Don't chase performance. Don't panic during volatility. Don't assume recent trends continue forever. The biggest mistakes in retirement planning come from recency bias, assuming the last 5 years predict the next 5 years. They don't. Understand that this approach requires patience and discipline. You're protecting wealth, not trying to get rich quick. For someone in their 50s or 60s, wealth preservation matters more than wealth accumulation. You're transitioning from the phase where you earn money to the phase where your money must work for you, without the ability to replace losses through earned income. This is also the time to consider Roth conversions. If you have traditional 401k money and you believe tax rates will be higher in the future, converting portions to a Roth IRA where you pay taxes now but enjoy tax-free growth and withdrawal may make sense. Run the numbers with a qualified tax professional, but the basic logic is simple. If tax rates are going up and you have to pay taxes eventually, paying at today's lower rates could save you enormous sums over a 20 or 30-year retirement. Nothing in this constitutes specific financial advice for your personal situation. Each person has different circumstances, different risk tolerance, different time horizons, and different financial goals. What I've shared are principles and frameworks for thinking about retirement planning in an environment of elevated debt, potential inflation, and concentrated 401k exposure. Before making any specific investment decisions, consult with qualified financial professionals who understand your complete situation and can provide guidance tailored to your needs. The choice is yours. But remember what I said at the beginning. The largest pension funds in America, the sophisticated institutions with research teams and decades of experience, are reducing stock allocations. Central banks around the world are buying gold at rates not seen in 50 years. Corporations are holding record amounts of cash. These aren't random actions. These are signals. When you understand incentives, you understand behavior. Institutions are positioning for a different environment than the one we've experienced over the past decade. They see the same debt levels, the same valuation metrics, the same policy constraints that I've described. They're acting on that information. The question is whether individual investors, people with 401ks who have worked decades to save for retirement, will recognize these signals before they become obvious to everyone. That's why this channel exists. We observe patterns, we study history, we analyze what sophisticated institutions are doing, not what they're saying. And we translate complex economic dynamics into practical frameworks that everyday investors can understand and act upon. If this analysis makes sense to you, if you found value in understanding the principles behind 401k risks and diversification strategies, subscribe to this channel. Hit the notification bell so you don't miss future analyses. The information landscape is filled with noise, predictions, and hype. What I offer is pattern recognition based on decades of studying how systems work, how incentives drive behavior, and how history tends to rhyme even when circumstances differ. Your retirement represents your life's work. Treat it with the seriousness it deserves. Understand the forces at play, and make decisions based on principles, not emotions or recent market performance. That's how you protect what you've spent a lifetime building.